VUSA, Vanguard's S&P 500 ETF, is the most popular fund on the platform, by a mile. Tracking the famous S&P 500 index and holding over $33 billion in assets, it's no wonder why so many people flock to this fund. But what if I told you that there is a similar fund on the platform that could be even better than VUSA? Remember, I'm not a financial advisor, so don't take this video as a recommendation. I'm just going to be presenting some facts on a topic that I find interesting. If you do want advice, then seek it from a financial advisor, not me. Now, before we look at a few of VUSA flaws and look into an option that could be even better, let's first remind ourselves of the details of VUSA. VUSA can be found on a whole range of investing platforms, but on Vanguard's website, it's found under the ETF section. A couple of standout features is that the fund invests in around 500 stocks, of course, and it has a remarkably low ongoing charge of 0.07%. By scrolling down, you can see that the fund tracks the Standard & Poor's 500 index. The S&P 500, as we know it today, started 64 years ago, in 1957. This is when the index started to track 500 companies. The S&P 500 is rather special when you compare it to other indices, because other indices tend to include companies based on certain requirements, such as size requirements or market sector involvement. The S&P 500 is actually committee-based, meaning that a board of members have to decide whether or not companies are eligible. They still use rules as a guideline, but the committee also has some power. It includes 500 of the largest companies in the US. These companies make up around 80% of the total US markets. And whilst the 500 stocks as we know them today may only be 64 years old, the data can actually be extrapolated back to 1871. This site has the returns of the index each year, showing that since 1871, the total returns, which are inflation adjusted and include dividends, average out at 8.7% per year, or more appropriately, give an annualized return of 7.06%. That's over 150 years of top quality stock market returns. There's no wonder why this index is so famous and has so many assets. On Vanguard's website, you can see that the recent returns for the fund have been massive, with 134% growth over the past 5 years, and the benchmark earning 323% over the past 10 years. This probably explains why VUSA has around $33 billion in assets. People often use this fund to make up the US part of their portfolio, or to even constitute an entire portfolio in itself. No matter who you talk to, they've probably got some of the S&P 500 fund in there somewhere. But what if I told you that the S&P 500 isn't all what it's made out to be? What if there is a better option? In comes a US Equity Index Fund, one of the index funds that are available on Vanguard's platform. The fund invests in over 4,000 stocks, but has an ongoing charge of 0.1%. This means that you get much more diversification when compared to the S&P 500, but the cost is 0.03% more. You can see that the fund tracks the Standard & Poor's Total Market Index, so the entirety of the US markets are included in this fund, instead of the top 500 stocks. This improved diversification means that the risk of individual stocks collapsing is less significant. It's the exact same reason as to why people invest in global index funds, to gain broad coverage of the global markets. So the argument is, why invest in the top 500 US stocks when you could have them all? This is reflected in the top holdings of the funds too. This data shows the top holdings for the S&P 500 ETF. The top holdings make up a total of 29%, with Microsoft alone making up over 6% of the fund. This can be compared to the US Equity Index Fund, where the top holdings make up around 24%, and Microsoft only makes up around 5%. It is this concentration in large cap growth stocks that has done so well for the S&P 500 in recent history. The likes of Facebook, Microsoft, Apple, Amazon, Tesla, and Alphabet have been on an absolute storm recently. It's commonly thought today that we're in a winner-takes-all environment, with the biggest companies dominating the market, and not showing any signs of holding up. But what does the data say? Well, this is not the first time in history that the top stocks have ruled. From 1930 to 1950, AT&T consistently made up around 6% of the US market. In fact, in some years, it actually exceeded 10%. But come on, this time is different. Apple is a much better company, with more innovation going on and just a broader market reach in general. But you cannot forget that AT&T was the most used telecommunications network in the world. This was at the edge of pioneering technology. There will always be a story for the biggest companies to be unlike those that have come before, but they don't always last. The top companies in the world always chop and change places, and they certainly don't always make the best investments. I'll link Ben Felix's video below where he quotes some data that states that for every decade starting 1930, 40, 50 up to 2010, the top 10 companies in the US made up around 23.6% of the markets. However, the average annual returns of these stocks trailed the market by 1.51% per year. It does seem confusing that the world's biggest companies can be producing below average stock market returns when compared to the rest of the market. but there is an explanation. The companies in question are of course large cap growth stocks, which are by definition some of the most expensive stocks in the market because the future expectations are so high. The problem is that investors can overpay for these expectations, so even if the stock does perform well, it doesn't mean anything if you overpaid for the stock in the first place. The expensiveness of a stock can be described by its price to earnings ratio. This shows the PE ratio of the S&P 500, which is currently at 29.5. 29.5 is considered to be a bit on the high side. The global markets, for example, have a PE ratio of around 25. But to put things into perspective, Tesla has a current PE ratio of around 334. This means that investors are paying an extremely high price for the future cash flows of a company. But if their earnings don't deliver, then the stock will perform poorly. This over-expectation and relative underperformance for the largest companies in the world explain the overall underperformance of the largest companies. To link this back to the S&P 500, we can see that it may not be such a good thing to have such a high concentration in these large cap growth stocks. But the S&P 500 is by definition a large cap index. The US Equity Index Fund includes large, mid, small and even micro-sized companies, which not only adds diversification, but it also increases the expected returns of the fund. A concept known as the size factor explains that small-sized companies have higher expected returns than large cap companies. I have explained the idea of factor investing before, but I am going to recover it again soon, so keep an eye out for that video in the next few weeks. Ultimately, the weighting towards large cap US stocks in the S&P 500 has been great for its performance over the past decade or so, but the long-term data suggests that it may not be the best approach. This comes back to the big question that you have to ask yourself when choosing between the S&P 500 ETF or the US Equity Index Fund. Are you willing to pay an extra 0.03% to ensure that you diversify across the total US markets? It would be completely fine to use either fund to make up the US part of your portfolio, and I'm not going to recommend either fund over the other. All I'm trying to do is provide an objective view of the S&P 500. It's not very often that people talk about the downsides of the prestigious index. Yes, it is the most famous index in the world, and yes, the returns have been great for such a long time, but that has no correlation with what the future returns will be. You should think about funds or investing strategies in a critical way. Why is the fund so good? Is there a good reason behind it? Or am I just following a crowd? Following the crowd isn't always the wrong decision, but it's certainly not always the right one either. We recently showed how chasing after the best fund returns can hurt us as investors. This graph from Vanguard shows that investor returns trail fund returns across the board. My point is that the above average returns that the S&P 500 has produced is not what makes it a good investment. In fact, it could maybe even mean the opposite. The success of the S&P 500 when compared to other global funds can partly be explained by the growth of the US markets as a proportion of the global markets. This chart here shows the global capitalization proportion for each country since 1900. The US is in dark blue. The chart shows that in 1900, the US made up around 15% of the global markets, but as of today, it is around 55%. Because the US markets grew to become the force that they are today, the stocks in the US markets obviously benefited from this. But how much bigger can the US markets grow? Will they always be the biggest force, or will another victor emerge? The graph shows that Japan used to make up almost 50% of global markets in 1990, but has since declined. This graph shows Japan's markets since the peak of their global reign. Their current value is still not as high as it was in 1990. Now, this is a very extreme example, because the price of Japanese assets were extremely inflated in the 90s. But the point still stands. If the US does start to falter, then so could their stock returns, which have been so reliable over the past century or so. Again, this is the basic reason why many investors go for low-cost global portfolios. I've said it 1,000 times, and I'm probably going to say it another 1,000 times, so get ready. By investing in a globally diversified portfolio, investors can minimize the risk that individual countries or market sectors carry. Whilst a global fund would have had a large allocation to Japanese equities in the 90s, it would have also held other countries that would replace the failing Japanese markets. This graph shows the annualized returns for different countries from 1900 to 2020. Bear in mind that the returns are not inflation adjusted. There is huge variation across the board, with the US leading the pack. However, the standout point for me is that the worst country returned just 3.9%. whilst the entire world returned a very respectable 8.3% without inflation, which places it amongst the best. So if you do use the S&P 500 or even the US Equity Index Fund to make up your entire portfolio, I'd just bear that in mind. Do you want to try and guess the best performing country over the next 30 or 40 years, or will you be happy to settle for the very solid returns that the global markets will produce over our lifetimes? Imagine the scenario where it is the US markets that is at the bottom of this graph over the next 50 years. I'm not saying it will happen, but nothing is impossible. If this did happen, and you were to invest in a 100% US portfolio, how long would it be till you move? In fact, would you move at all? I guess it depends on how much you believe in the US markets. Hopefully you can see that it's not all about following investing trends blindly, or whatever is popular at the time. In the world of investing, things can change very quickly. And if you're not in a well-constructed portfolio that manages risk, then you could be on the wrong side of some serious market upsets. I recommend that whatever your strategy is, you invest with diligence, do your own research, and make sure that you believe what you invest in. After all this talk about global funds, I'd recommend that you watch this video here, where we discuss some of the best global funds on Vanguard's UK platform. And with that, we'll leave it there. Thanks for watching everybody, and I'll see you next time.